You finally did it. You bought an investment, it went up, and you sold it for a profit. Nice work. But before you celebrate, the IRS wants a cut of that gain. And here's the part almost nobody realizes until it's too late. How much you owe doesn't just depend on how much you made. It depends on how long you held it. Get this one detail wrong and you can hand over nearly double the tax on the exact same profit. Same investment, same gain, wildly different bill, decided by a single calendar date. It sounds like the kind of thing only an accountant would care about. It isn't. This one rule quietly shapes when smart investors sell, how much they keep, and how much they simply give away. And the good news is, it's not complicated. Once you see how the pieces fit, you'll never look at a sell button the same way again. So let's break it down from the ground up. By the end of this video, you'll know exactly what gets taxed. The two flavors of capital gains, the rates that apply, and a couple of perfectly legal moves that can shrink the bill, or erase it entirely. No jargon left unexplained. Just the mechanics. Let's start with the most basic question. What is a capital gain really? Strip away the jargon and it's simple. A capital gain is just your profit when you sell something for more than you paid for it. There's one term you need, and it's painless. Your cost basis is what you originally paid. Your buy price, basically. So the formula is gain equals sale price minus your cost basis. Buy an investment for $5,000. Sell it later for $8,000, and your gain is $3,000. That $3,000 is the profit. And that's the part the tax applies to. Not the whole $8,000, just the gain. Now here's the piece that trips people up. And it's genuinely good news. You're only taxed when you actually sell. When you realize the gain, as long as you're still holding the investment, any increase on paper is what's called an unrealized gain. And unrealized gains are not taxed at all. Think about that. Your investment could double, triple, climb for 20 years. And you owe nothing until the day you sell. The tax bill is something you trigger, on your schedule. That timing is a tool, and most people never realize they're holding it. Okay, you've sold, you've got a gain, it's getting taxed. Now comes the single most important fork in the whole topic. There are two kinds of capital gains, and which one you get is decided entirely by your holding period. How long you own the investment before selling. Here's the line, 1 year. If you held the investment for 1 year or less, that's a short-term capital gain. If you held it for more than 1 year, it's a long-term capital gain. That's the whole test. 1 year to the day, and the difference between the two is huge. Short-term gains get taxed as ordinary income. That means they're stacked on top of your paycheck and taxed at your normal tax bracket, the same rate as your salary. For higher earners, that can climb all the way up to 37%. Long-term gains play by a completely different, much friendlier set of rules. Hold past that 1 year mark, and your profit qualifies for special long-term rates that are deliberately set lower than ordinary income rates. The government is basically rewarding you for being patient, for investing rather than rapid-fire trading. So the same exact profit can be taxed two completely different ways. The only variable that decides it? Whether you cross the 1 year finish line. So if long-term gains get those special lower rates, what are they exactly? This is where it gets pleasantly simple. There are only 3 long-term capital gains rates: 0%, 15%, and 20%. Which one applies to you comes down to your taxable income for the year. 3 tiers, low to high. If your income is on the lower end, your long-term gains can be taxed at 0%. Yes, completely tax-free. The big middle, where most people land, pays 15%. And only at higher income levels does the rate step up to 20%. Stop and compare that to ordinary income for a second. A typical worker might pay 22 or 24% on their salary, while their long-term investment gains are taxed at just 15%. And a lower-income investor could pay 0 on those same gains. That's not a loophole. It's exactly how the system is designed. The takeaway is this: long-term capital gains are one of the most lightly taxed kinds of income there is. Just being patient enough to cross that 1 year line moves your profit into this gentler 3-rate world instead of your regular bracket. Now let's put real numbers on it, because this is where the one-year line stops being trivia and starts being money in your pocket. Imagine you have a $10,000 gain. Same investment, same $10,000 profit. We're only going to change one thing: how long you held it before selling. Scenario 1, you sell it, say, 11 months. That's short term, so it's taxed as ordinary income. Let's put you in a 24% bracket. 24% of $10,000 is $2,400 going to taxes. Scenario 2, you wait just a little longer and sell at, say, 13 months. Now it's long term, taxed at the 15% rate. 15% of $10,000 is $1,500. Look at the gap. $2,400 versus $1,500. By holding for a couple of extra months, doing literally nothing but waiting, you saved $900 on the very same gain. That's a $900 difference for crossing one date on the calendar. This is why seasoned investors always check the calendar before they sell. If you're sitting on a winner and you're close to that one-year mark, those extra few weeks of patience can be one of the highest paying decisions you make all year. Last piece, and it's the one that can shrink the tax bill the most, or wipe it out completely. So far, we've only talked about gains, but investments don't always go up. And losses, it turns out, are not just painful, they're useful. Here's how. Capital losses cancel out capital gains. If you have a $10,000 gain on one investment and a $4,000 loss on another, the loss offsets the gain. You're only taxed on the net $6,000. Deliberately selling a losing investment to offset your gains has a name: tax loss harvesting. And if your losses for the year actually exceed your gains, you can use up to $3,000 of that net loss to offset your ordinary income too, your salary, and carry the rest forward to future years. But the real superpower is where you hold your investments in the first place. Inside a tax-advantaged retirement account, a 401k, an IRA, or an HSA, capital gains tax simply does not apply. You can buy and sell inside those accounts all day long and owe zero capital gains tax on the growth. None. That's the quiet lesson under everything today. The account you invest in can matter as much as the investment itself. Same stock, same gain. Taxed in a brokerage, completely sheltered in a retirement account. So let's tie it all together. You're taxed only on your gain, sale price minus cost basis, and only when you actually sell. Hold an investment for 1 year or less and the gain is short-term, taxed as ordinary income at your normal bracket, which can run all the way up to 37%. Hold for more than 1 year, and it becomes long-term, taxed at the gentle rates of 0, 15, or 20% based on your income. That 1-year line is worth real money. In our example, $900 saved on a single $10,000 gain just for waiting. On top of that, losses offset gains to shrink the bill. And tax-advantaged accounts like a 401k, IRA, or HSA skip capital gains tax entirely. None of this requires an accountant or a spreadsheet. It just requires knowing the rules before you hit sell. So the calendar works for you, not against you. If this made capital gains tax actually make sense and maybe saved you a few $100s next time you sell, hit subscribe. This whole channel is the money stuff nobody ever bothered to teach you, explained plainly. And since short-term gains ride on your ordinary tax bracket, here's the perfect next watch. How tax brackets actually work. Your ordinary rate. Explained. No, a raise won't cost you money. I'll see you there.